Greetings viewers. I welcome you to the series on security analysis and investment management. I would like to share that my name is Dr. Isha Raval and I'm working in the capacity of Associate Professor and IQAC Coordinator at Vivekananda Institute of Professional Studies, Technical Campus, Delhi. Now today in this session, as I said, security analysis and investment management. So here today we will be learning how to describe the procedures for measuring the risk of a portfolio of securities. There are a few words which I've just now used. The risk, portfolio and securities. The risk is how much anticipated loss would you be incurring. Portfolio of securities is actually a combination, a pool of assets which you are creating so that your diversification of risk takes place. So as an investor, whenever you start thinking of putting your funds in certain assets, you always first of all identify the what return am I going to get? What are the risks associated with this particular asset or the different assets which you have selected? How do you select these assets? What is the right combination of these assets? How much weightage should be given to a particular security or how much weightage should be given to a particular asset when you are thinking of the portfolio? So portfolio is actually the pool of assets that can be an insurance policy, that can be a fixed deposit, that can be a stock, that can be anything, that can be gold, that can be silver, it can be a precious stone. So it can be any asset which you intend to put your funds in to get a desired level of return. So that desired level of return is very clear to you when you are starting to invest, because there is a clear-cut investment objective and you stay invested for a particular duration of time. You decide the time, you decide that this is the expectation which I have from the portfolio, from the investments which I am making today, and how much quantum of risk can I bear, and is my risk appetite matching with the kind of portfolio of securities which I am intending to put my funds in. Now this sort of analysis is actually done by you at the very beginning of the stage when you are trying to invest, when you are thinking of investments. So you analyze the return, you estimate the risk, and then you move ahead that yes, the risk appetite is matching, and you start investing your funds in that particular portfolio of different assets. Now the question arises that I may be able to calculate the risk. I may understand that if I put my funds in a post office scheme, or if I put my funds in a particular asset, I may be saying that okay, treasury bills, the risk is zero. Or maybe I create an FD with a post office bank, or I create an FD with the government sector bank. I may estimate that my risk is technically zero. Whereas when I select different categories of assets, or if I select different combinations of securities, when I select different firms to put my funds in, it is very, very difficult for me to calculate the individual risk of these securities and then what is the overall risk of the securities. When I talk about a specific security, I would say that I will calculate the standard deviation, I will calculate the variance, and then I can say that this is the percentage of risk associated with security A. Now, the person may say, I'm citing an example, so 10% risk associated with security A, 15% with security B. But now when I want to calculate what is the overall risk, so is it 10% or is it 15%? Or is it something between 10 and 15? Is it more than 15? Is it possible? Is it possible to lessen it below 10%? Yes or no? Because as an investor, all these questions will be hovering around in my mind. So how do I estimate that risk? Let us understand what are the different techniques of calculating the risk of a particular portfolio of securities. Now, portfolio risk is actually measured by calculating the standard deviation of the portfolio. I would like to highlight it is the entire portfolio and not just a single security, because standard deviation alone cannot calculate the portfolio risk. Why do I say that? The sole reason is because there is a need to ensure that all the different standard deviations of all the securities which are there in the portfolio, they are accounted for with their weights. Now this is an important term, with their weights. That means how much weightage is given to a particular security in the entire portfolio. So out of say 1 lakh, if I have invested 10,000 in a particular security, the weightage of that particular security will be 10,000 divided by 1 lakh, which comes out to be 0.10 or 10%. So you need to calculate, you need to account for the weights and the existing covariance and the correlation between the assets. So security A and security B, they may be correlated. They may be positively correlated, they may be negatively correlated. So what is the correlation between the two assets will actually help us in determining the overall portfolio risk. So in this regard, covariance is very important. We need to calculate the covariance. So correlation and then covariance. What is covariance? It can be defined as the extent to which the stocks move in the same direction. So if one stock is rising, the other is also rising. If this one stock is falling, the other is also following. Are they moving in the same direction or are they moving in different directions? Now the best part why most of the people or most of the investors, they prefer investing in a portfolio which with the stocks which are negatively correlated or which move in different directions is very clear. For example, if there is a stock which is not doing so well, but the other stock, because it is negatively correlated to the first one, say stock B is negatively correlated to stock A, then in that case the overall impact of loss will be much lesser. Why? Because A is going down, whereas because B is negatively correlated to A, it is rising. So you understand that overall the impact of loss would be lesser dependent on the quantum of loss which is happening on A or the quantum of profit which is happening in B. This is again dependent on how much funds, what is the weight of investment in the entire portfolio. So whenever we want to calculate the portfolio risk, we first need to calculate the different standard deviations of the individual stocks and then what is the existing covariance and correlation between the stocks. So this is how we calculate the portfolio risk. So if the two stocks, they correlate positively, say if the correlation is +1, they will either increase or decrease hand in hand. They will move in the same direction. On the other hand, if two stocks, they correlate negatively, if there is perfect negative correlation, say -1, it implies that if one stock generates a positive return, the other stock is unlikely to generate a positive return and vice versa. Therefore, portfolio risk calculation includes the three main variables as I just discussed. The first, how much is the investment, the weightage of the respective asset in the portfolio. The second is the standard deviation of those assets, and the third is the covariance of these assets. So using all the three variables, how do we calculate portfolio risk? As you can see on the screen, the portfolio risk is actually the square root. That means we are again calculating the standard deviation by when we are saying square root of weight of asset A raised to the power 2 multiplied by the standard deviation of asset A raised to the power 2 plus similarly as many assets we have, weight of asset B raised to the power 2 multiplied by standard deviation of asset of B raised to the power 2 and so on and so forth. So we are actually doing a summation of the weighted square root of the assets, the weight of the assets with their standard deviation, and when you do a summation of it, you do the square root of this entire value, what you get is your portfolio risk. But there's an important word which is written here, as you can see in the formula, the correlation between asset A and asset B multiplied by the standard deviation of asset A into standard deviation of asset B. This entire statement, weight of asset A into B into correlation of A and B into standard deviation of A and into standard deviation of B, this is entire thing is nothing but the covariance between A and B. Let us understand this with the help of an example. So we have expected return and the risk of 5 different companies, A Limited. Then we have taken Sensex, which represents the market. The second company is B Limited. The treasury bills with bearing a risk of 0% because they are the safest investment. And the last organization which we have taken is C Limited. So A Limited has expected return of 17.4% with a risk of 20%. Sensex has return of 15% and risk of 15.3%, which is measured in standard deviation. B Limited 13.8% as expected return and 18.3% as risk. Treasury bills 8% expected return and zero risk. As I just stated, that treasury bills or government securities, they are risk-free assets. There is no risk attached to them. And the last one is C Limited organization. Expected return is just 1.7%, whereas the risk associated with it is 13.4%. So this is the data which is given to you, and you are supposed to assume a two-stock portfolio with, say, INR or Indian rupees 50,000 in stock A and 50,000 in stock C. So we have not considered the other stocks. We are just assuming that you have a total of 1 lakh with you. You put 50,000 in A and 50,000 in C. What is your expected return, and how would you calculate the overall risk of the portfolio? So to begin with, let us start calculating the portfolio return. So when you want to calculate the portfolio return, the formula says that it is a weighted average of the returns of all the stocks. So when you do a summation of the weighted average of the stocks, what you get is your expected return of the portfolio. Now here in this question, because we have already stated that 50,000 is going in A and 50,000 is going in C, that means the weightage is exactly same. So 0.5 will be W1 and 0.5 again will be W2. So 0.5 WA, weightage of A, multiplied by 17.4%. plus 0.5 multiplied by 1.7%, because in the question itself the expected returns are given. So for A it is 17.4 and for C it is 1.7. When we calculate this, what we get is 9.6% as our expected return. And you can see that this expected return is falling between the return what we expected from A and B, A and C. So A gave us 17.4 and C is giving us 1.7. When we do an average, we come to a figure called 9.6, which is lying between these two figures. So the portfolio return is lying between the return of one asset and the return of the other asset. So there are two bars, the lower one and the upper one. So always remember that the portfolio return will always be somewhere between this. It cannot be less than the lowest and it cannot be more than the highest return. Now, there is another method for doing this same calculation. So when you are investing, you already know that when you're investing, there can be recession, there can be below average performance, there can be average performance, there can be above average performance, and there can be boom in the economy. So obviously, the returns will also move in tandem. So what we've done is we've assigned certain probabilities in all the 5 scenarios, and we have inserted the returns expected from A, the returns expected from C, and then what are the returns in case there is recession, in case there is below average performance, in case there is above average performance, so on and so forth. So when we do all of this, we try to let us calculate again the portfolio return given the expectations of and the different probabilities under different scenarios. So here again, when we do the calculation, our expected return comes out to be 9.6%. This is exactly what we did earlier. So as when you start calculating, it is better when you are not given any sort of scenario, you are just given the weights and you are given the expected return. It is always better you just multiply the weight of stock A with the expected return of A, plus you do the weight of B or C if you are investing in C with the return of C, and you calculate the expected return from the portfolio. So this was just another example which I cited. How can you do the calculation of expected return? So in case there is a question which gives you the probabilities and which tells you the expected return of these stocks in different probabilities in different scenarios, you use the second method. But when straight away a return is given to you wherein the weightage is also given and the expected return is also given, you use the first method. So this is we've done the calculation of what is the expected return. Now let us try to calculate what is the expected risk, because when you are investing understanding that there is a certain amount of risk which is attached to all the securities. Now here, because you have chosen to invest only in security A and in security C, we have done the calculation accordingly. Now here, as you can see, that we are calculating the portfolio risk using the formula as I am just showing you. We are using the formula wherein we are calculating the expected, your square root of the weight of asset A raised to the power 2 into standard deviation of asset A. So we will be using this same formula here when we do the calculation, and after applying this formula, what do we get is our portfolio risk of 3.3%. Now 3.3%, that sounds very interesting to an investor, that wow, the risk has gone down, but how this has happened? If you actually see the portfolio, the portfolio which we created, we chose two securities, stock A and stock C. So let us go back to the risk. How much was the risk of A and C? As you can see on the screen, A Limited has a risk of 20% and C Limited has a risk of 13.4%. So when we were calculating the return, we said that the return will be somewhere between the return of A and the return of C. So when we did the calculation, we found that A was giving us a return of 17.4% and C was giving us the return of 1.7%. So when we did the calculation, we got a return of 9.6%. Clear cut? It is lying between 1.7 and 17.4. But the same thing is not applicable to the risk calculation. And here comes the importance of creating a portfolio. Here in this case, the risk of A is 20 and the risk of C is 13.4. So as a layman, you may say that obviously when we are investing, the minimum risk we have is 13.4 and the maximum is 20. So when we are combining these two securities, our risk should lie between these two outliers, 13.4 and 20. But when we did the calculation, to our surprise, our risk comes out to be 3.3%, as you can see on the screen. This 3.3 is much lower than the bare minimum risk associated even with security C. But how this is really magical. And here comes the importance of creating a portfolio. Why is it that the risk is so less when we are combining two securities? Now when we understand, here the portfolio risk is much lower in either of the stocks, because 20 and 13.4, the actual is 3.3, because of the when we do the calculation here, the actual average comes out to be 16.7, but the portfolio actually provides an average return but much lower risk because of the presence of negative correlation. So as I stated, as I was explaining, that the importance of correlation or covariance is of paramount importance when we are creating a portfolio. Why? Because a company may not be equally correlated to the other company. That means if a stock from an energy sector will definitely not move in tandem with the stock in an FMCG sector, a stock from an education sector, a stock from an insurance company. Because during COVID times, you must have observed that the stock prices of the insurance companies were rising. The medical insurance were rising or they were falling. So when people are making a lot of claims, obviously the companies are running into losses. But at the same time, the stocks of FMCG sectors were doing pretty good. Why? Because in any case, even if you are at home, you are consuming. The consumption is going up. The stocks of pharma companies, they were rising. But at the same time, the steel sector, they were not performing so well. So when you're creating a portfolio, you have stocks from cement industry, you have stocks from steel industry, you have from FMCG, you have from insurance sector. Now all of these stocks, they may be negatively or positively correlated. We need to understand that when we are creating the portfolio, we must have such stocks which are not positively correlated. Why? Because two stocks, when they can be combined to form a riskless portfolio. How? They can be only riskless only when the coefficient of correlation is -1. That means one is rising, the other is falling in the equal proportion. That means if the stock A rises by 10%, stock B falls by 10%. If this is the kind of movement, then we can create a riskless portfolio. Why? Because the loss in one can be covered up by the profit in the other, whereas if there is a profit in one, the loss in the other is actually neutralizing the profit of the first one. But we must understand one more thing, that risk is not reduced at all if the two stocks which we have, there is positive correlation. One falls, the other also falls. Now in this case, when we are creating such a portfolio wherein we have selected all the stocks from the same industry, so if there is a bad announcement about a particular industry, if there's an unfavorable government policy belonging to a particular industry, the stocks of that entire industry will fall. No matter whether it is Tatas or Birlas, if they are just one particular sector, all the stocks will go down. So as an investor, it is very important to know that whenever we are selecting the stocks, they should not be positively correlated, because the benefit of risk diversification will not come into the play. Portfolio is technically created. The sole purpose of creating a portfolio is to diversify the risk. The selection criteria may be different. You may choose different techniques. You may say that you're going to put equal weightage to all the stocks in the portfolio. You may say that you're going to first of all do the correlation analysis, and then you're going to put in the amount in the portfolio. The choice is yours. But one should always avoid having all the stocks which are positively correlated, or all the stocks with a correlation value of +1, because in that case the risk can never be reduced. Usually what we have observed over the years, in general, the stocks, they have a correlation of approximately 0.65. So the risk is actually lowered, but it is not eliminated at all. That means we cannot completely eliminate risk. There's a very important question which is usually asked, that can risk be eliminated? Can risk be reduced? So the correct answer is that yes, risk can be lowered. It can be reduced, it can be diversified away, but it cannot be completely eliminated. It is impossible to eliminate the entire risk by creating a portfolio, because usually the stocks, they have a positive correlation of close to 0.65. And as an investor, you may hold multiple stocks. So when you're doing that correlation analysis, you really have to be very, very efficient in calculating the correlation value and the covariance of all those stocks in the portfolio. Now, what would happen to the risk of an average one stock portfolio as more randomly selected stocks were added? That means you are not doing any analysis, but you're just randomly adding the stocks in a portfolio. So you started with one stock, you added the other, the second, the third, the fourth, and that kept on increasing. So what will actually happen to the overall portfolio risk? Will it increase or will it go down? See, technically, the risk will definitely go down. It will definitely decrease, because whenever we are adding more stocks, they may not be perfectly correlated than the initial portfolio risk. Say, for example, you took one stock, the risk was 10%, you added another stock to it. The risk may go down from 10 to 8. When you're adding the third stock to the same portfolio, the correlation between these two existing stocks, the portfolio which you've created and the next one, they may not be perfectly correlated. Now, because they are not perfectly correlated, there is a surety, there is an assurance that your portfolio risk will go down, and they will, over a period of time, it would remain relatively constant. Because as you are adding more and more of stocks, you're actually trying to represent the market. That means you are ensuring that you have stocks from different sectors, from different industries, and then your portfolio is so huge that it kind of represents the Sensex, or it kind of represents the market indices. So yes, if you're adding stocks, certainly the risk will go down, it will decrease, but at the same time, it can never ever be eliminated. Okay. Now, just look at this graph. We have 3 stocks here. In fact, we're doing a comparison between the risk and the return, and we are representing stock 1, stock 2, and then there is a larger one. Now, if you look at it, the portfolio, the risk of stock 1 is 35, whereas the risk associated with the larger one, the bigger portfolio with lot of stocks, is just 20%. That means by adding more and more of stocks, what we have done is we've tried to reduce the risk from 35% to 20%. When we were investing in just one stock portfolio, it was 35. When we invested in two stocks, the risk reduced a little, but when we have a large quantum of, you can say, stocks in our portfolio, a lot of stocks in the portfolio, our risk actually came down to 20%. So that is why we say that whenever we create portfolios, they always result in risk reduction, but not risk elimination. Now, as you can see here, we've represented on the x-axis, we have the number of stocks, and there we are starting with 10 stocks, 20, 30, and that goes up to 2000 plus stocks. And on the y-axis, we are representing the portfolio risk. Now, towards the lower segment, that means 20% is the bare minimum risk which will always be there in the market, which is known as systematic risk. The risk which can never ever be eliminated, which can never ever be diversified. But when we are investing in the initial, say just one stocks or two stocks or maybe 10 stocks, we see that our portfolio risk is pretty high. But as we increase, we move on from 10 to 20 stocks, 20 to 30 stocks, and we increase our number of stocks, our risk goes down to 20%. And it will never touch the x-axis. Why? Because the market risk is always there. So if there is inflation in the economy, the market risk is there. So you are going to get the brunt of that inflation. If the prices are rising, that's applicable to all the industries. So that market risk cannot be diversified away, which is known as systematic risk. So by portfolio diversification, by adding on number of stocks in your portfolio, you can actually reduce the risk, but this risk will never be less than the market risk. Now, as I just stated, that standalone market diversification risk, when we do the total risk, it is a combination of market risk and then firm-specific risk. Market risk is that part of a security's standalone risk that cannot be eliminated by diversification. So as we just saw in the graph, 20% is something which we have to bear. That's the bare minimum risk. Whereas firm-specific or diversifiable risk is that part of a security's standalone risk which can certainly be eliminated by diversification. So that means when we're talking about standard deviation, when we're talking about variance of a stock, that can certainly be diversified. That is possible by investing in different securities, but market risk is systematic risk and cannot be diversified away. So I would like to conclude by saying that as more stocks are added, each new stock has a smaller risk reducing impact on the portfolio. So when you have thousands of stocks, the addition of next one stock will not have the risk reduction capacity. It will not have a lot of impact on the risk reduction. And the portfolio risk falls very slowly after about 40 stocks are included. So till 40 you will see a reduction, but after 40 it is usually seen that the next addition will not have much of impact. And by forming well diversified portfolios, investors can actually eliminate almost half the riskiness of owning a single stock. So in today's session, we've understood how do we calculate the portfolio risk, and how can we diversify a portfolio, how can we reduce the quantum of risk. We understood that the systematic risk cannot be diversified, but unsystematic risk can actually be eliminated by including more and more of securities. That's all for today. Thank you so much. Happy learning.